Gopal Balachandran now joining in. Thank you so much for taking time out. Now, when we're taking a look at the combined ratio this quarter, we've seen an uptick sequentially. So what has led to this rise in the quarter?
So that's a great start if you were to ask us. So again, I think as you rightly mentioned, the combined ratios for this quarter stood at roughly at about 104.5% at an aggregate level. And we did get impacted by a set of catastrophic events in this quarter. We had floods in Gujarat, we had floods in Telangana, we had the North Indian floods. Now, if one was to kind of factor in for all of these flood events, and if you were to exclude the impact of these cat losses, then the reported combined of 104.5 comes down to about 102.6%. And this number, when you look at it on an year-on-year basis for a similar quarter, there is actually a marginal improvement of roughly about 0.2% insofar as the combined is concerned. But I think I would kind of say that our business is more long-term, and therefore you should always end up looking at the numbers ideally on annual cycles. And hence, to that extent, quarterly there could be aberrations in terms of the business mix, in terms of the loss experiences, etc., etc. But what we stand committed is what we also put out as a part of the analyst call, which we did on Friday. We stand committed to the number that we spoke about to the market, which is to get to an exit a combined ratio of 101.5. So at this point of time, we are not making any changes to that. And hence, to that extent, that is what we will be largely driving it at.
Right. I also wanted to talk about, the fact that while your growth has remained strong across the segments and you also gained market share in FY25 so far, overall the industry growth has declined in the month of September. Do you see any headwinds in growth at a macro level?
Yeah, so I think that's again a good question, because I think the beauty of the general insurance business that we are at, and particularly for companies which are into multi-line, and that's exactly how things play out. I think you will obviously see at different points of time, possibly maybe some bit of competitive intensity play out, maybe to some extent demand getting possibly impacted. But the good news is, I think there are always opportunities that arise or result from some of the other segments that we are into. And that is what we kind of stay invested in terms of seizing opportunities from an ICICI Lombard standpoint. And that's exactly, as you rightly said, for us, in that sense, if you look at across the key segments that we generally talk about, which is motor, health, and the commercial lines put together, you're absolutely right. I think we did have an outperformance when you look at whether it is motor in the aggregate or whether you look at even health as a category. On both those lines of businesses, I think we have been able to have a significant outperformance relative to the industry growth. On the commercial lines, and specifically in the context of fire, I think in line with what we have been talking to the market, at this point of time, we are seeing maybe elevated levels of competitive intensity. And to that extent, at least specifically in the context of fire, we have largely maintained our market share in that segment, whether you look at it on a quarter two or whether you look at it even on a half-yearly basis. However, given the infrastructure thrust that the government is making on projects, logistics, etc., etc., the rest of the lines of commercial businesses for ICICI Lombard has actually seen a positive growth momentum. When you look at it in the context of engineering, marine cargo, liability, now all those businesses have kind of done well for us.
All right. And you had also mentioned the rising competition. So going ahead, can we see any price hikes or any product launches that you have in the pipeline for certain categories that will help alleviate this?
Let's start with commercial lines, for example, right? So when I said that the market has been competitive in fire insurance as a line of business, now this is a segment which is high on exposures because these are large properties, large risks that we underwrite. And therefore, to that extent, there is an element of reinsurance that pretty much every company works on. And reinsurers also are providers of capital. And therefore, when they see pricing possibly dropping a lot, they would not necessarily be making available free reinsurance capacity. Now, all these conversations is something that will start to happen towards the beginning of the renewal cycle, which is generally towards quarter four of this financial year. So, and just to kind of refresh, if you were to go back 3-4 years back, that is exactly what happened. When the reinsurers did see stress in pricing from a market perspective, they clearly indicated that in case if companies wants to avail reinsurance capacity, then they will have to kind of increase prices. So possibly, given that at this point of time there is an elevated levels of price competitiveness, maybe at the time of the renewal cycle, things will start to kind of look upon in terms of increase in pricing. But in that context, when you look at it for ICICI Lombard, given that we are largely trying to stay disciplined in terms of risk selection, I think hopefully the terms of reinsurance renewals that we are likely to expect should generally be positive. So hence, to answer your point, there could be some kind of a price action when you look at it in the context of commercial lines. When it comes to health, I think as you rightly mentioned, for us, the newly launched solution, which is Elevate, and I think that has been kind of received very well across multiple stakeholders. And that's the reason why I said our market share is now at about 3.5, 3.6% in that range.
Right. And during the recent meet, the government announced the exemption of GST on health insurance as well, below 5 lakhs. We may also see exemption on health insurance premiums for senior citizens as well. What's your take on this, and how is it that you see this benefiting your company?
I think I'll just put this in the context. So at this point of time, I think let's wait for some of this crystallizations to kind of get fructified. So we will. So at this point, so until then, I think obviously we will not want to necessarily comment on as to what is the change, to what extent, on which segments of businesses could this be made applicable, etc., etc. But having said that, I think if you look at it in the context of the opportunity that one sees on health, and leave aside the large part of the population, which is the vulnerable section of the society, who are largely kind of getting covered under the government-sponsored mass health programs. If you were to keep that aside, and the rest of the insurance, if you were to see the extent of penetration, it is significantly lower. And that is where the opportunity lies. And from an insurance regulator standpoint, I think the regulator has been rightly kind of positioning the opportunity to make sure that as companies, we are kind of working towards increasing penetration. Now, any exemption, any reduction of tax rates, insofar as an individual consumer is concerned, obviously we will have, that's an absolute welcome, because insofar as their out-of-pocket payment is concerned, it is definitely a positive. When it comes to the insurance companies, obviously we will have to do our evaluations and see as to whether is there really an impact consequent to the exemptions to whatever extent that that proposals could come through. I think we will evaluate and take an action appropriate there too. But in general, I think the whole thought process in terms of why the exemption, to what category, etc., is all largely to drive penetration on the one hand, and equally to make sure that insurance is becoming far and more affordable when it comes to consumers.
All right. And on the investment front, what is your sensitivity towards the rate cut cycle, which may begin soon? What kind of, how investors should be reading into that?
To answer the first part, see, the beauty of the business for us is, I think the entire investment book is a proprietary book. It completely belongs to shareholders. And therefore, to that extent, the investment calls that we end up taking can be for a longer period. And that is exactly how ICICI Lombard has always historically positioned our books. And if you were to look at across various rate cycles, and at times when the interest rates have stayed elevated, as in when the interest rates have been higher, at those times, obviously, we have kind of gone significantly long in terms of the duration of the book. And just to kind of explain, at this point of time, we are running a duration of close to about 5.41 years. So hence, to that extent, at least insofar as the position of the book is concerned, I think we are rightly poised, depending on as and when maybe a rate cut cycle could kind of come through. We did go long over the last couple of years specifically, taking advantage of the high interest rate regime, because it kind of augurs well, not only in terms of higher interest accruals for us, but at the same time, I think it possibly also helps us in terms of any realization of gains as and when the rate cycle were to get fructified at. So we are kind of rightly poised in terms of the opportunity that one sees there. And that is why if you see our overall unrealized gains that we have on the overall investment book, that's roughly at about 25 billion rupees, of which close to about 16 billion is on the equity side, and roughly about 8 to 9 billion rupees is on the fixed income portfolio. And we will obviously have a lot more depending on how the rate cut cycle plays out. But to your second point on the investment leverage, I think again, as I keep saying, I think our businesses are more longer term in nature, and therefore to that extent, you always have to end up looking at any of the matrices over a long term horizon. And in that context, now when you look at the investment leverage, which for maybe quarter two, or let's say on a half yearly basis, stands at about 3.91. In general, to the market, we have talked about maintaining the leverage at roughly at about 4 times.
Right. So great to have you on the show then. Thank you so much, Gopal, for taking the time out and speaking with us today.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.